Welcome to the Real Estate Industry Update. I'm your host, Daniel Ricati, here with Kyle Paxton for another video. Today, we're going to discuss kind of the economic outlook for real estate here now that we're heading into 2026 and how it looks compared to 2025. I think as most people who have been involved in real estate just kind of understand 2025 was kind of a weird year. It was a transition year, It just seems like for most people in real estate, it was kind of a down year for everyone. I don't know about you, Kyle, but I can always tell how good of a real estate year is when I start preparing tax returns for our real estate brokers. And and they're always like, yeah, I had a down year. And it seems like that was across the board for 2025.
Yeah, Daniel, you're right. That's been my observation too. It does make our jobs easier, admittedly. Lower tax bills tend to be more friendlier conversations, but it is indicative of a quote unquote down transition year like we're talking about. So, we talk about real estate data moves pretty slow, right? We're filming this on the back of Q1 of 2026. We blinked and now it's April. And so, we're keeping this conversation pretty high level in what we've seen and kind of what we're going towards in 2026. 2025 ended better than expected. And 2026, given what we've talked about here, and then 2026, there's some more optimism, and I do feel there's some stabilization kind of in the market, and we're starting to transition. Okay, last year was a weird year. We're starting to digest the data, figure out where we go from here. And I think we're going to see a lot of that movement happen in 2026.
Yeah, and Kyle's right here. 2025, it actually kind of ended on a little bit of an uptick. It actually ended by kind of doing a little bit better than projected. It doesn't feel that way to anyone in 2025, but technically it did.
On paper.
Yeah. And what that does is it kind of gives us a little bit of a ramp up for 2026. Like, okay, we're going to have a better year. It's not going to be this overwhelming year. That's not how real estate works, right? Real estate, one of the nice things is it moves a little bit slower. That means it goes up a little slower, it goes down a little slower as well. And so this year, I think what we're going to see for 2026 is more like a selective reopening, but it's going to be better in 2025. We're going to start seeing that. So let's start getting into like why 2026 is, this first quarter feels different from 2025 already. I mean, the market already feels better just from talking to other real estate brokers and everyone in the whole industry. It just feels like this whole story is just kind of everyone's a little bit more optimistic, like Kyle was saying.
Yeah, so we're starting to see where the improvements show up first, the things you typically see, right? Pricing, cap rates, actual deal flow, starting to see an uptick in these areas. Generally more positivity across the board. You can't distill this down into the nuances of particular asset class types. I think office is still kind of lagging behind the rest of the bus in that regard at a high level, especially in the local markets that our offices are in. But overall, just starting with those kind of big ticket items of pricing, cap rates, and deal flow, we're starting to see more momentum there. Daniel, you want to take us into cap rates a little bit?
Yeah, I mean, so cap rates is kind of the good, just high level indicator of how the market is doing. And as Kyle and I here at James Moore, I mean, we deal with a lot of clients all over the country. I would say our core clients are kind of the South.
Yeah.
So we're a little bit more, especially Florida specifically. So we're really more involved. That's just one thing with real estate. You got to realize it's really location specific. So we're going to use some general terms here, but some areas are outperforming other areas. Asset classes are performing, like Kyle was mentioning. Office has always been in a tough spot ever since the pandemic, but we've seen certain things explode, like industrial has exploded. I'm starting to see that pull back. That's just how the market works. When everyone jumps in, it starts pulling back. Multifamily has been having a really tough time in Florida right now, and just how that kind of looks. So we're kind of expecting what we want to just see is improvement here. So when we're looking at cap rates, what we're really seeing is that, it's very selective on what cap rates are doing. All right. Cap rates kind of overall are just pretty low, and we're trying to get a little bit better improvement from cap rates. All right. But I feel like the good assets, they're moving. The bad assets are still being, unfortunately, not moving at all. They're kind of just stagnant. And that's how this market feels right now. It doesn't feel like everything is down, but not everything is up. So it's really important to make sure, like if I own real estate, is this a good asset? How can I improve this specific asset? Because that's going to be the biggest difference maker right now in this market.
Yeah, and I see that, I mean, kind of across the industry from the single family residential homes all the way through. Again, specifically kind of in our Florida markets and things like that. That's a common thing we're seeing. Rent growth. So supply is easing, purchasing power still isn't back. But this part of the market is still 2025-ish, right? And we're seeing some slow change here. We've already talked kind of about multifamily. But 2025 had started with strong renter demand. Excuse me, my words are hard. But momentum cooled a little bit later in the year. By Q4, multifamily vacancy was just south of 5%. Effective rate growth 0.2% year over year. And then in 2026, average apartment rents rose to about $1,700, up 0.2% and 0.4% year over year. But the year over year is down in the first Q1 2026 over Q1 2025. Like Daniel said, we are seeing some differences here. Regionally, Sunbelt's cooled a little bit in rent growth, and we're looking more of kind of the Midwest and mountain regions are where we're seeing more of an uptick in rent growth. And so obviously each year this varies kind of location. As Daniel mentioned, we see a lot of data. We have a lot of clients who enter multifamily, GPs located all over the United States that hit the Southeast hard over the last couple years. And we're seeing some of that activity cool a little bit and pivot to other regions.
Yeah, and I think rent growth here is something we want to look at because there's a lot of people, especially in the multifamily industry. The first 2025 was the first year we really got negative growth in rent, not across every industry, but particularly multifamily. Yeah. And so when you see something like negative growth, it looks bad because we're already, like we talked about, we're compressing our cap rates. Well, rent is going to immediately affect your cap rates and things like that. We want to get that net operating income up. And rent's a great way to do this. And we're already getting many of factors like our expenses and things are increasing. And so what we'll really see as a good sign in this market is what's going to happen with our rent growth. Okay. Part of this also has to do with, if you remember a couple of years ago, rent was the opposite. It was growing probably a little too fast, right? And so what 2025 ended up by being is a little bit of a correction year, but more of a plateau overall, a little bit of negative growth depending on the actual sector. I think what we'll see back in 2026 is we'll see that slight increase again, kind of get back on track. But we got to remember, I mean, rents were growing up, 25, 30% a year just 2-3 years ago. And I mean, that's a lot, for a tenant trying to stay. Now, of course, that's what the market had. Everything was going at that time. But so we're just seeing a little bit more of a steady market getting back to where we need to be. What I'd really like to see is just not negative rental growth. Like that's the hardest one to plan for.
Yeah, absolutely.
And so, some of that had to there's a lot of factors in it. The construction of multifamily over time, especially here in Florida, multifamily just exploded and everyone, and now it's a little bit overbuilt. I mean, that's just how the market works, right? And then, capitalism is going to come in play here. There's a correction. And so now we're going to build on that correction. And so I expect 2026 to have a little bit better year. And depending on, what happens for the rest of the year, we'll see how good of the year we can build off from there.
Absolutely, Daniel. And I'm going to jump now into lending and kind of the lending environment here. I don't know about you, Daniel. Q1, I'm seeing a little more activity in the lending space. Some refis going on. I see more movement. There's demand for tax returns to get deals pushed across the finish line. So it does feel like the lending market is less frozen than it was kind of on the front end of 2025. More capital to go around, better demand for lending, and typically more confidence in credit. But the average deal that we're seeing still needs the right sponsorship, leverage, cash flow, exit story, the whole 9 yards. I'm still having banks really dissect our tax returns to the statements that my clients are providing, and I'm having to do a heavy lift to get deals across the finish line just in helping interpret data. It feels heavier than it's felt in the last couple of years in terms of that type of activity and, for lack of a better term, quote unquote, pushback on financial records that we're providing from lenders. But I'm certainly seeing kind of more activity in that space to kick off the year in 2026.
Yeah, I would say what I would give lending is, okay, we're finally back open for business. 2025 felt like no lenders wanted, at least not conventional lenders. All
They don't
right.
want to dance. Yeah.
They had to find alternative lenders. Nobody wanted anything. And it was really tough. I mean, sometimes depending on like the sector, like office, no one could get any kind of debt.
Yeah.
I can't think for office in 2025. And so 2026, their dreams would just be like, all right, we're not opening up everything, but we're going to finally start accepting some loans again, start looking at some deals. But like Kyle was saying, you still got a long road ahead of you. Okay. The interest rates, they got cut several times at the end of 2025. But then they kind of, stayed. They made that target of 3.5 to 3.75. So that's kind of where we're at right now. The Feds will meet again here at the end of April, and we'll see what happens there. There's a lot of expectations that they probably won't cut it again, but you never know. So it seems like the Feds are kind of okay where they're at, and like, we've cut the rates. Let's now let the market do its thing. And so that's just going to basically open it up. Okay, financing's back on the table. But what does that look like for real estate and our clients? That just means that, one, if you have existing debt that's already on the table that's coming due here shortly, you need to start getting prepared for it. It doesn't mean you have no options, but it does mean you have to understand what the banks are wanting. Okay. It's a risk assessment to them. All right. So you need to make sure your books are good, your tax returns are in order. What can you work on today to increase those numbers on your property? Okay. Make them look good. Work with the bank well in advance, a year before it comes due. Be like, all right, what can I do? Sometimes there's factors outside of just real estate. Like, hey, the bank's more likely to work with you if you hold more assets with them. There's little things like that we don't think about, or getting someone to vouch for you, something like that. And so really it's just, all right, I got a year before this is going to come in. I don't know exactly what the market's going to work. Banks are more willing to work with you. So if that's an uptick, just realize they're not just writing checks though. Underwriting is still a tough process, and you need to expect that.
Absolutely. And I'm going to jump now into another area that we're seeing some consistency with 2025. And that is just our operating costs, right? And insurance is weird right now. Property renewals can look better, but the total cost stack and kind of all the add-ons everywhere else isn't. And we're seeing that kind of continue into 2026. We're seeing our clients really get squeezed on the operating costs across the board, from our fees to everywhere else, right? It all kind of matches together into that one big box there. But, it's 2026. I don't think it's going to be kind of an expense normalization story at all through the end of the year. It's just really, I think, different pressure points are arising in this year. And so, you may have less pain within your property insurance premiums itself, but then more pain on these the liability costs we're talking about, other operating costs kind of up and down the board. Big ticket item in Florida, we spend most of our time is property taxes, right? That conversation is right front and center right now. But we are seeing just increases in pretty much, all operating costs across the board. And I don't see that going away anytime in 2026.
No, I would say this area is probably what feels the most like 2025. And I don't think it's really going to change. I mean, expenses are just, it is what it is, right? I don't think they're coming down anytime soon. The most we can hope for is that they just level out. They kind of plateau. Like Kyle's mentioned, some of the biggest ones, especially here in Florida, is property taxes and insurance, right? I noticed insurance prices, they were jumping for a couple of years there, like, 20, 30% every year. This year, it finally feels like it's a little bit more of an average jump, with 3, 5%, something in that area, something that's a little bit more I can budget for, which is necessary because we already talked about rents not being able to be an increase. And so that's just squeezing your profit. Okay. On top of the more expensive financing options if you had to refinance. And so, when real estate doesn't cash flow, it doesn't really become a great option for you. Okay. And so what we're probably seeing for 2026 is that it's just going to feel like 2025 when it comes to pricing or comes to your expenses. So you need to realize that, like, hey, pricing's not really going to get better. So I really need to dive into my specific asset. Okay. Because I'm probably not going to be able to decrease my insurance costs, generically. You can look at your policy, make some policy changes, and people have absolutely done that and found good ways for realizing I don't need half this stuff in my policy, things like that. Property taxes, you're very limited on. You pay what you pay for the most part, unless you feel like you want to, go out there and actually, take your valuation that the county does. And say that I think you're wrong. You can do that. There are ways you can go out there and basically, get your valuation changed, which can decrease your taxes. So that's something you can always consider about. But I think really here, it's just more about understanding the expectation. Costs in general across the board are not coming down. So look at my specific assets and figure out, okay, where am I overspending? Where am I not paying the most attention? Where can I really affect that net operating income, especially if I'm expecting the rents not to really increase significantly?
Yep. And I want to touch on one more thing as we wrap up here, talking about underwriting adjustments. And as part of our mid-year strategy here as we go into Q2 and onward for 2026. We talked about this already, but I think the theme of 2026 is similar in terms of new deals. It's similar in a lot of ways to 2025, and that we're still kind of in that period where we separate the really good real estate investors from the not so good, right? And it's going to be much more. Our underwriting needs to be really, really targeted and market level, and not more macro, on a national scale. We've already talked about some of the regional differences we're seeing, particularly in multifamily and things like that. I think that's going to become more and more prevalent. That huge wave of multifamily in Florida is drying up a little bit or slowing down some. And so pivoting the strategy on, okay, that was the big wave. Where we go now, right? And so, it's really keying in and digging deep. It's kind of that same theme as the lending, right? All of your models need to be much more scrutinized. You're running much more conservative vacancy concession projections, making sure you're factoring in those operating cost increases, keeping in mind the different refinance scenarios, and being modest on exit cap compressions will really drive successful underwriting in this period.
Yeah, I think the biggest difference in the market we're in right now is it separates the really good real estate investors, just the casual real estate investors, the people that got in when the market was hot and you can't lose, right? Now you can lose if you're not doing the right things. So when you're out here underwriting your properties, finding new properties, projecting, you really need to make sure you have a conservative model. All right, what happens if I'm going to work on my vacancies, but I need to make sure that my deal still works if vacancies are worse than I think it will be. Okay. What happens when I want to refinance and the market's not where I want it to be? Okay. I see people all the time doing this. They go in there and they start budgeting expenses. They don't budget that they're going to keep rising.
Yeah.
It's all like, when's the last time property taxes have gone down? When's the last time insurance has really gone down? You need to make sure that you understand that's going, but still at the same time, not expecting significant bumps in rental properties. And then at the end of the day, I really think if you're in real estate, it really comes down to the specific asset. Find the asset in the location that you believe, and that asset will be a different maker. It'll be an outline from the market in general. Don't look so much as the market is going to make you win, more of it, that specific asset. What can I do to increase that specific asset? And by basically investing in that, that's basically what real estate is at its core, is really like, hey, the market overall in real estate's great, but I have the ability to go in and find the diamond in the rough, make changes, rehab it, find where the missing pieces are, and then really increase the value of that property and the net operating income and things like that. And now I have this amazing asset because I was the difference maker. And so that's what I feel like the market is for 2026. It's just a generic uptick on everything. Now it's your time to go in there, be the difference, be the reason why your ROI and your investment is significantly higher than everyone in the market because of your skills and your experience that you bring to real estate and that specific asset.
You're a good hype man, Daniel. I'm fired up.
Well, I don't know about you, Kyle, but I want all my clients and even potential clients, I want you to do a good job, all right? But when you have good assets and you're doing great out there and we're all making money, then believe me, I'm making money, we're helping each other. The worst is when everyone in real estate is not making money. Everyone tightens up, no one's happy. No one wants to pay the tax guy. I promise you that. Anything when no one's money is made. But unfortunately, tax returns have to get paid whether you make money or don't make money. Right. And sometimes, as Kyle knows, it's actually more complicated when they're not making money. It can be very complicated. So we want to make sure that we're helping out any way we can, which is just basically you're the difference maker. Find the right asset. There are deals. The market is slowly getting better. But it's not just going to come to you. You have to find it. Thanks for hanging around. We'll see you next time.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.